President Trump is desperate to have the stock market go higher again. But why? So in the last week or so, President Trump, on an almost daily basis, through his press briefings and press conferences, he has specifically cited that the stock market will start to go higher again and that people should buy the dip in stocks. It's very interesting. I can't really remember any other president talking about it quite this much. Now, we've had the Federal Reserve Chairman in the past talk about the wealth effect, but the president actually acting as pumper-in-chief, going up there and pumping the stock market higher, this is very interesting. So on January 2nd, I'm going to read you a Reuters article that it says, Trump says there was a stock market glitch in December, but it will rise when trade deals fixed. And he says, quote, we had a little glitch in the stock market last month, but we're still up about 30% from the time I got elected, end quote, says Trump. Quote, it's going to go up once we settle trade issues and a couple of other things happen, end quote. And he's basically been saying similar things on January 4th in another press conference or press briefing. So he's pushing this point home. It's very interesting that we have a president willing to do and say this. And I think this goes back to my theory about what Alan Greenspan, now that he was out as Federal Reserve Chairman and was actually allowed to fully speak his mind, because Greenspan does, throughout the past, occasionally drop truth bombs. So yes, Greenspan is a sellout, and in the gold community and Austrian school economics and free market community, he is a traitor and a sellout. But he does drop truth bombs. And what he said, and I referred to this last week in one of my live stream shows, was that basically the annual U.S. government tax revenue, so much of it now is made up in capital gains taxes. So that's probably why Trump is well aware of this, why he is so worried. Okay, so today's live stream show is going to be very short. I actually, thanks to Louis Camersano at Small Gold, looked through my analytics, and I was actually able to see that most of the people who listen to my videos now only spend between 14 minutes and 22 minutes total looking at all my content. So even if my content is 40 minutes of good content, or I'm interviewing a very well-respected guest for 30, 40, 50 minutes, most people only spend at most 22 minutes now. It's kind of weird, but it is what it is. So I'm going to try to be a little bit shorter and more succinct with this live stream show, and we'll see if I can mix in shorter things now for some of you guys out there, because I guess you don't want to hear me talk with my insights. Okay, so there are very interesting articles coming out about China. There's a ton of anecdotal evidence that things have drastically changed, especially in the last 3 or 4 years in China, but definitely over the last 10 years. And on January 5th, 2019, there was a Bloomberg article, attached a link for you guys to take a look at this. It says China has a dangerous dollar debt addiction. With $1.2 trillion needing to be rolled over this year, the threat of a funding crunch is rising. So this is only a day old by Christopher Balding. And basically he explains how we all know that China has a credit crisis, but some of the Chinese companies were borrowing dollar-denominated debt, because the excuse I hear from a lot of China bulls still and China apologists is that basically China is going to wipe away the debt. They're going to print the RMB. They're going to do bailouts in RMB-denominated debt, and it's not going to matter. You know, the similar type of excuse for Japan and why Japan didn't collapse 30 or 40 years ago. But the problem, like I've been saying too, is that in addition to all that RMB debt, the $40+ trillion worth of RMB credit outstanding, and it's massive, and there's massive debt in Chinese households now. There's a ton of anecdotal evidence for that. You can look all over the internet for it. But there is also now a massive amount of dollar-denominated debt. And the dollar-denominated debt outstanding in China is so large now that it is almost as much as China's full trade reserves for their liquid reserves. Jim Rickards says that China has about, give or take, $2 trillion in liquid reserves. Now, China says they have $4 trillion, but if you speak to Jim Rickards and other experts, they say that $1 trillion of that is already committed to One Belt, One Road, which is basically a jobs program for a lot of Chinese and bribes for foreign governments and stuff in exchange for their resources. So China can lay debt traps, just like the U.S. has laid debt traps. So China is putting themselves in a really dangerous spot here. The other $1 trillion that Jim Rickards said out of the $4 trillion that China has in total reserves, Jim Rickards says that is illiquid, and that it is in like sovereign wealth funds and hedge funds and stuff, and China cannot liquidate that and use that to pay off debt or bailouts or anything without collapsing asset markets or other investments they've made. So the analogy that I'm thinking of is like a poker Texas Hold'em analogy, and I was running this by my best friend. I've been thinking about this for weeks, how to explain this to you guys. And since, we're only 5 minutes in, I can take the time to do this for a couple minutes. So basically, the U.S. and China are playing heads up at a Texas Hold'em table for a very, very large pot, okay? And the hole cards for the U.S. are a pair of pocket jacks, okay? Which can get you in trouble if you've played enough Texas Hold'em. You realize sometimes that they can get you in trouble. China's hole cards are pocket aces. China's like, yeah, we're going to win this thing. It's guaranteed. And so it flops, which is the next three cards in the Texas Hold'em, the three cards that come out after the hole cards, the community cards. It flops ace, 9, 10. So China looks at the board, and China sees that, wow, we have a set of aces. We have 3 aces here. We have basically the odds of us losing this hand are very, very low. And the U.S. keeps playing the hand because the U.S. had the big blind. And let's say that China didn't go all in with the aces. The U.S. had the big blind with the jacks, and China may have raised. And since the U.S. had the big blind with the jacks, the U.S. maybe just said, okay, we'll call. We'll keep playing. We'll figure out ways to keep playing. We'll see what happens with the remaining cards that come out. Because there's still, 5 community cards that come out. You have the flop, the turn, and the river. And so basically China's in the lead here, but the U.S. has a chance at a straight draw. So the U.S. has jacks, pair of jacks, and sees 9 and 10 on the board and an ace. And the U.S. says, you know what? Maybe we'll get lucky. Maybe we'll hit the running king, queen on the river, on the turn in the river, and we'll get that straight draw, and China's going to lose. And you know what happens? This is, I think, what has basically happened over the last 10 years, that China has overplayed its hand. China has gone all in on this crazy credit stuff. Over the last 3 or 4 years, Xi has started kicking out all the best and brightest and hardest working foreign businessmen and entrepreneurs there and small business owners. They've been taxed. There's huge tax increases on foreign businessmen in China. Even if the foreign businessmen have worked very, very hard and diligently to assimilate into Chinese culture, they've worked hard to learn Mandarin at an acceptable or good level. They've married a Chinese bride, all these things to fit into the community. And the Chinese government is still basically saying, you're a foreigner, we want you gone. Even though they helped build the economy, helped create jobs, that's the attitude in China now. So basically, poker analogy here to finish it off, the U.S. is still in the game. China, maybe China forced the U.S. all in at some point after the flop there, because China said, we have 3 aces, we're going to win this. We're going to go push all of our chips in, we're going to go all in. And the U.S. said, you know what, I'm feeling lucky, I'm calling. And it hit king, queen. So U.S. had jacks in their hand, and there was ace, 9, 10, king, queen. And the jack that the U.S. was holding hit it on the straight. Or the flush. Well, not the flush, probably not the same suit, but it hit on the straight. So the straight that the U.S. hit, a high straight, beat China's 3 aces. That's the poker analogy I would use that has basically happened. So the U.S. was not doing very well in 2008 with the banking system, the mortgage crisis, the housing crisis, the real estate bubble, but the behavior that China has done in the last 10 years, especially in the last 3 or 4 years, has really diminished their chances of being so much superior to the U.S. in the future. China has a lot of problems. The U.S. has a lot of problems, but, China did not have around a 400% debt to GDP ratio 10 years ago. Hey, Bradley, that's what we would call, if you play enough poker, that's what you would call a bad beat. So if you play the percentages, if you play the probability, if you have 3 aces out there on the flop, and you have the aces on your hole cards, and a pair of aces, and then you hit the ace on the set, you should push it. And basically the U.S. has just gotten lucky. So China had the higher probability of winning, a much higher probability, and they kind of overplayed their hand, and they got a bad beat. That's what I see happening to China now. And some of it is self-inflicted. Actually, a lot of it's self-inflicted with the stuff that's going on in their housing market, how much of their GDP is tied to speculative real estate, and how they're treating the foreigners that help build their economy and help teach them, how to build private sector businesses. They're kicking them out now. They don't think they need them. And there's a ton of anecdotal evidence. I talked about this in the past live stream last week and other live streams about problems in the Chinese economy. And basically a Chinese professor, this was out on Zero Hedge on Saturday on January 5th, Chinese professor censored after admitting real GDP growth is below 2%. So basically this, let's see the guy's name. He's the economics professor at Renmin University in Beijing. And he said that he estimated China's growth in gross domestic product could be as low as 1.67% in 2018, far below the official rate. And his presentation was pulled, even though it had a lot of views in China. China got all their social media to scrub it. And the presentation still has 1.2 million times as much, 1.2 million views on YouTube. So I'll attach a link to the story if you want to see that. The other one, like I said, is China has a dangerous dollar debt addiction. Hello, Scott. I don't think it's all President Trump. I think a lot of the mistakes that China has been making started before Trump even won the election. From seeing the anecdotal evidence that has been posted online of videos in China from like Serpensa and Lao Y86 and ADV China, China has been, President Xi has two different images. So his international image outside of China and among like the West here and the mainstream media is totally different than his image inside China and what his policies and stuff actually have been happening the last 3 or 4 years in China. Actually, guys, I think China, one of the reasons why I think China is preparing for war because they know their economy is having immense problems, is starting to rapidly deteriorate. So I think that's one of the main reasons they are looking for a war. They're looking for a big distraction for the people. Probably the first target, and I've heard a lot of my friends and other sources I talked to mention this, is Taiwan. So, a lot of the people in mainland China want China to take back Taiwan. So I could see that happening. Hello, PS. I think the tournament, I think the US and China are going to both have a good amount of power in the next global financial system, but the people in the alternative media, the people in the gold community, there's smart people who keep repeating saying this, like Luke Roman and many others, Peter Schiff, and they're saying how great China is. And the truth is that they are not examining how the evidence has changed, how the facts has changed. There's a ton of anecdotal evidence, tons of stories coming out of China, how things have changed a lot in the last 10 years. Look, if you calculate GDP, like what the Chinese professor said in that article, basically China's debt to GDP ratio, there's an argument to be made that their debt to GDP ratio is already over 500%. And history is quite clear what happens to countries with 500% or larger debt to GDP ratios. Hello, Greg. Happy New Year. Thanks for sending me the extra money and super chats. Much appreciated. Why? Because of pension funds and people have all their savings in the stock market. Well, all the savings aren't in the stock market. People buy stock mutual funds, bond mutual funds, and most people, average middle class or working class people on Main Street in the US, their savings are also in their house, in their home equity. So it's not fully accurate about the stock market, but yes, those three major asset classes are what basically affect annual tax revenues for the U.S. federal government. They need those capital gains taxes now. And that's why I think they're worried about asset prices in the three major asset classes staying low for more than like a handful of months or 6 months or something like that. Like a 12-month or more asset price crash would be a panic for them. Now, if you're a hedge fund manager, you can still make trading profits shorting things, but the average retail investor does not make money when asset prices fall. So I think there would be a large decline then in annual tax revenues for the U.S. government. Hey, Peter, thank you for sending me the $10 in Super Chat, and then you asked me a weird question, why am I so cocky? I'm not cocky, I'm just delivering information that a lot of people in the gold community and alternative media don't want to hear. They've repeated for 10 years or more to you this stuff that Peter Schiff is a brilliant guy. Peter Schiff woke me up. I learned a lot about Austrian school economics from Peter Schiff. However, Peter Schiff keeps repeating that China is going to decouple. China is better because they produce stuff. They manufacture things. Well, what if the Chinese factories, a lot of them are making stuff that people don't want. There's massive overcapacity there. They're producing things and piling up inventory, and they're already getting bailed out by the banking system. So you can think I'm cocky. I think I know some of the information that a lot of people in the gold community and the alternative media just don't want to either they ignore, they're too lazy to do research. I know a bunch of people in the gold community now that claim to be experts that don't even do 5 minutes of research a day. I will not name names publicly. I'm not one of those people, but I do know a lot of the people like that. There are also a lot of people that are getting paid thousands of dollars a month to pump stuff. Okay? I just saw an interview come out after one of the mining stocks crashed, and then I saw an interview on a large YouTube channel larger than mine, and I was thinking that there was probably a paid promotional interview there to help the stock price and help a capital raise. Okay? So I will drop some truth bombs. Lewis told me to mention that earlier because he said so few people were listening when I mentioned that later in my live stream a couple days ago. Okay, well, that's pretty much it for now. There's a lot of crazy stuff going on in the global economy, but it looks like Trump is going to keep doing this. He's not a financial advisor. He is not giving financial advice. I guess he doesn't give a fuck about the disclaimer, right? So so he's going to keep pumping stocks, I guess. And the main reason, I think, is because of capital gains tax revenues. You mentioned the pension funds, even with high asset prices that we've had with this, there was a 10-year stock market rally and real estate prices returning to 2007 levels or higher in many cities and states in the U.S., there is still a massive underfunding of pension funds. So I think the pension fund stuff, the politicians to get elected in many of those Democrat cities and states, and you say, oh, you're political, Jason, you're wrong about this. Look up the pension funds, most of them that are in the worst shape, that are in the most trouble of collapsing first and having runs on them, are all in predominantly Democrat cities and states, where some of the areas there's been Democrat control for over 50 years straight. So your Detroits, your Chicagos, California, New York, New Jersey, Illinois is in immense trouble. Michigan's in immense trouble. So there's very few Republicans that get elected in those cities and states. And if there is a Republican that gets elected, maybe they only get a term or so. They're predominantly Democrat controlled. Healthy, wealthy, and stealthy. Ray Dalio is talking about the end of a major credit supercycle right now. Dalio's been kind of wrong in his predictions for a while. Dalio has also been talking about a beautiful deleveraging for about 6 or 7 years, yet there is literally zero evidence globally that there has been any deleveraging, any reduction of credit. In fact, it is the exact opposite. Over the last 30 years, looks like my super chat got removed. Over the last 30 years, credit has, it's 20 years. Over the last 20 years, there was a Wall Street Journal article last week. Credit has tripled globally. So we are over $250 trillion in credit globally outstanding. So for Ray Dalio to say that we have a beautiful deleveraging is total BS. There is no example of deleveraging in American households, in China, in U.S. corporate credit, in pretty much anything you can, in government debt, in Europe or in the U.S. There is no example of deleveraging, really. So Ray Dalio, I'm not sure if I'd listen to anything he said, except you should own some gold. And by the way, Ray Dalio's hedge fund risk parity trade, that's going to blow up. It's definitely going to blow up. Hello, Kirsten. When China hits the first city in the U.S., people finally wake up. I don't know if we're going to have an actual physical war with China. I think we'll have a Cold War, like economic warfare first for a while before we have a physical war. And from what I've heard from some of my friends who have lived in China, they think China is going to go after Taiwan first, and China is going to try to basically establish like some type of toll system through the South China Sea. So the original narrative that was presented for the South China Sea was that China wanted the South China Sea because of oil and natural gas reserves, but that's not entirely correct. From what I've heard now, that China wants to basically charge a toll on all economic ships, like cargo container ships and everything else that goes through the South China Sea. So they basically want to be like the toll booth operator and have their military like guard it and charge a big fee for every ship, economic ship that goes through there. And the U.S. is, we'll see what the U.S. decides to do about that. But my friends who have lived in China, what they say with China's foreign policy is that besides China wanting to secure natural resources and food, so metals, natural gas, oil, agricultural commodities, that China also wants to potentially go after some of these small Asian countries that are close to it. So we'll see what happens besides just Taiwan. Healthy, wealthy, and stealthy. I've been talking about the European banking crisis for 3 or 4 years, and it was papered over with currency swaps and rules changes and secret bailouts for years now. That's why it didn't blow up sooner. The European banks basically blew up in 2008 and nothing was fixed. They were not really recapitalized. Rules were changed. There's been secret currency swap bailouts since 2008 to the European Central Bank that have not been disclosed. And that's what's delayed the European banking crisis until now. Some countries in Europe have even started to nationalize the banks. But we'll see what they decide to do. Europe is a total mess. And that's why the market is giving the U.S. a pass right now. Because most market participants are looking at Europe and the European banks and European government debt, and also seeing like the videos of the riots in France. And we just saw, I think, new riots in London over the weekend. And we're seeing examples of this, that people are more worried about Europe in the short term, but the U.S. is being given more rope to hang itself with in the long term. Hello, pipe fitters. There's actually a really good article by Ambrose Pritchard's Evans from 2016, and it's about how like academics at Harvard and the CIA and the deep state were the ones who were pushing the European Union in the first place, and they were the ones who selected a lot of the politicians in Europe, in the UK and the EU, to get them on board for the euro because they wanted like a United States of Europe, and they thought that that would prevent some wars and other reasons. And you know, it's not a viable thing. It's not going to work. Now, they may print over it, but there's a lot of reasons why the European Union is not working, and it was never a healthy relationship from the beginning, but I don't think it's going to work long term. But if the U.S. wants to bail them out and allow them to print more money and stuff to keep things together, or the U.S., the Federal Reserve or the U.S. Treasury is going to... Trump floated this over the summer and hardly anyone saw this. President Trump jokingly talked about the U.S. Treasury buying Italian government debt. Well, Poland is not in the European Union. So Poland is Eastern Europe, and the Polish culture is Eastern Europe is very different than what's going on in the United Kingdom and the European Union. Gold is good insurance. Douglas Sketskull. I think I screwed up your last name. I apologize. Are U.S. Treasuries the new subprime? I agree with Kirsten. They are not this year. They are being manipulated and kept in a trading range below the 3.25% on the 10-year, even though the yield curve is inverted. And the yield curve has been flattening for a while now, but if the Fed keeps hiking rates, that will further exacerbate the inversion on the yield curve. And normally, from what I've seen on some of the academic studies, it takes like 2 to 3 years for the effects of an inverted yield curve to start to reverberate throughout the economy and start to hurt it. So we'll see how much more inverted the yield curve gets, how much more the Federal Reserve decides to hike rates. Now, Danielle DiMartino Booth was on her Twitter ranting a lot this past weekend, and normally she's been defending Jerome J. Powell and saying that Jerome J. Powell is a reincarnation of Paul Volcker, and with the rate hikes that Powell is going to do what Volcker did, going to do the right thing, but she just changed her mind over the weekend about Powell. She said that Powell has caved and that Powell may not do any more rate hikes. So it could be now that Powell has finally gotten worried. Powell's worth a lot of money, so he doesn't need that job. Now, it would hurt his ego to get fired by Trump, but he doesn't need the money. He's worth over $50 million. I think actually he may be worth over $100 million. He declared like a massive net worth on his public declaration that he had to fill out before he took the job as Fed chairman. So he's worth a lot of money. He doesn't need the job. But, if Trump does fire him, that would look probably bad for his ego. Toby, but Poland doesn't do a lot of the stuff that the European Union requires them to do. Poland has very strict immigration laws and other things as well. So even if they are part of the European Union in some aspects, they don't do all the exact same policies that France is doing, Germany is doing, Spain is doing, Italy is doing, etc. There's a documentary out by Stefan Molyneux where he went and visited Poland for a couple weeks that talks about some of this, and there's other information all over the internet about this. Hey Douglas, the global economy is extremely leveraged, so no lesson was learned about debt and credit and leverage after 2008. All that was learned was that they faked a recovery, faked to pretend that everything was solved, that the financial crisis was behind us, and they faked that the economy was growing, and they just kept borrowing more and more and more. So corporate debt increased, government borrowing in a lot of countries increased. So that's why when the economy is so leveraged like that, that's why 1 or 2% rate increase is so much, because no important lessons that should have been learned during 2008 were learned. Hey, Michael, stagflation, I agree. We have stagflation now in the United States, and I think the best case scenario for there's stagflation in China. I just saw a video about food price inflation in China and rent in China. It's actually more expensive now to rent in a lot of Chinese cities for a crappy place, a crappy flat or apartment or condo than it is in many U.S. cities. I was shocked to learn that. So I think the best case scenario for a lot of economies is going to be stagflation. If the central planners, the Treasury departments, the central bankers, the bureaucrats, the politicians that are running these economies behind the scenes, if they mess up, it could be worse than just worse stagflation. Hello, Peter. Thank you for the additional super chat. I appreciate it. What will happen when state and local pension funds go bust? So I think what they will do first is similar to what happened in California. So rather than admitting that the money's not there, they will just start to tax the tourists more. So what California is doing now is basically they're running TV commercials for more and more tourism. And basically the tourists who come to California, they pay massive tourist tax on like rental car, airport, hotel, food, entertainment taxes. If they go to Disneyland, I think if you go to Disneyland in California, I think if you're out of state, I think you might even pay an additional tax on that too. So that's how they're temporarily in the short term doing this. And obviously this is not a fix. It's not a panacea, but that's how they're buying time. So it's going to be a tough conversation because politicians do not like to tell the truth to their people. Other than Ron Paul and a handful of others, they just don't tell. Politicians in general do not tell the truth to their citizenry the majority of the time. And so I think most of the politicians will just figure out new ways to increase taxes on like foreigners or increase taxes on tourists. Wherever there's pension fund shortfalls, rather than having a honest and difficult conversation like you would if you were a parent at the dinner table with one of your kids, telling your kids, hey, look, you need to stop doing this behavior, you're going to get in trouble. So the politicians do not want to have this difficult conversation with people They would rather just, and this is why you're seeing the Republicans and Democrats for the most part agree on increased government spending. You know, it's only like $5 billion here for the wall or a couple billion here for a political issue. In general, they're in agreement on 85% of all the spending increases for 5 years from now. Okay? So this is a political problem too, because the American people should take responsibility for this. They're not electing politicians who will say, I'm only here for one term. I'm going to tell you all the truth, and we're going to work on a hard solution. There's going to be a lot of pain. We're going to work on a legit long-term solution, and then I'm gone. And the American people are not electing people like that. You're getting people like Alexandria Ocasio-Cortez, who wants to tax, I guess, anyone over $1 million or something like that, like 70% of their income, which is going to hurt job creation and entrepreneurship in the U.S. And then the Republicans are bad too. Republicans are borrow and spend, and Democrats are tax and borrow and spend. So both political parties deserve a massive amount of blame for this. Democrats, a lot of them used to be, at least for a couple decades, an anti-war party. And when they started losing a lot of elections in like the 80s, they switched to being very pro-war, a lot of them. So, you know, as they would rather spend money bombing other countries or building bases and defending borders in other countries than fixing problems here in the U.S. The U.S. has big infrastructure problems and a lot of other problems. Scott, that is a great question. Which blows up first, the euro or California? I will take a pass for now. I think Europe already blew up, and I think there's secret bailouts going on now. And I'm not sure. No one knows. There's no transparency here. There's no audits. We don't know the real number of currency swaps. We don't know what's going on behind the scenes with the French banks that are holding bad counterparty risk. We know the German banks are bad. We know the Spanish banks are bad. We know the Italian banks are bad. There's 30% non-performing loans in Italy. Well, hey, Scott, I think, you know, because we can't tell which one's worse, I think that's why you have cash, some dollars for opportunity, and that's why you have exposure to gold and silver. And then, you know, if you need to earn some, this is not financial advice, if you need to earn some income, this is why you don't look in the stock market and you don't look in the bond market for income. There are other opportunities outside of the stock market and the bond market for income. Almost everyone's looking for income. Okay, guys, well, we're at 32 minutes, and according to my analytics, almost no one, actually stays and listens to all 32 minutes, or at least most of my listeners don't. So I'm going to wrap this show up for today. I'm going to continue to work on new guests for the show. Hopefully, I'll be able to reschedule Danielle DiMartino Booth. Apparently, she's not as happy with Jerome J. Powell, so I was going to ask her some questions if she thinks that Trump would actually fire Powell. So we'll see if I can get her on and ask her that question. Okay, bye for now.